Great. So in today's section, we'll quickly look at for IAS 40, recap on IAS 40, and then move on with the rest of the standards. IAS 40 basically talks about investment property. So IAS 40 talks about investment property. So investment property. So you can call it that. Great. So that is that. Investment property. Investment properties. Now, what happened is this. You should know about 5 items under this, as usual. Number 1, you know the objectives and scope of this standard. Number 2, some terms. Basic definition of some terms. Number 3, you should know the recognition. How investment properties are recorded in the books. The recognition. Number 4, how they are being valued. So that's measurement. Number 5, then the disclosure requirement. So I'll quickly look at these 3 and then move on with the game. Okay. Now, the objective of this standard is to prescribe the correct accounting treatment of investment properties to the extent that it prescribes how it should be recorded and measured in the books and its disclosure. Then the scope. In fact, it covers a specific properties like land and building, except for those covered in other standards. I will get it. Okay, so properties in land and in buildings, except those covered in other standards. Let's start with the terms. So I'll start defining investment property. So let's start with the terms. Right from the terms, we go to recognition and we go to measurement and say bye-bye to investment property. Good. Now let's see the first section. The first term that I will define is the investment property itself. What is it? Good. You may be asked to define it in the exams. So let's see. So let's define investment property. Now, the definition for investment property is a bit long. So I'll break it down into 3 different components. So when I ask you to define them, just summarize or put these 3 components together. So the first feature of investment property is a property made up of, so property made up of 1, land or building or part or both. In fact, this is the standard that have a lot of or. This standard or this definition have a lot of or. You see plenty. So when you talk about investment property, it's a property made up of what? Land or building or part of a land or part of a building where it belongs to you. So if you're in a family house and that building does not belong to you, your portion, the part that belongs to you. Or both the land and then the building, all of them are yours. That's the first definition or the first feature. Then feature number two acquire. So tell the examiner that, let me acquire with an intention not for resale or not for use in production of goods and services, or resale in an ordinary course of business. So course of business. That's the second feature. How do we get it? So the second feature says this: acquired with an intention not for use in production of goods and services, or resale in an ordinary course of business. You acquire it. So in summary, this point 2 is saying that you acquired it not for use. So in summary, not for use or for sale. That is all. So, and this one too, in summary, is saying that it is land or building. That's all. So, in short, if I should end here, investment properties are land and building not for use or sale. That is summarized version. This is a definition. How we get it? Good. Now, let me ask you a question. Why do you buy, or why will you buy assets, land, and building and say you are not going to use it? You are not going to sell it. What for? Buying sake, yeah? Okay. So here's it. So let's go to the reason for its acquisition. And all of them form parts of. But every step you see, or every stage. So let's see. But for the continuation, but for rental income, or we start with the or again, or rental income or long-term capital appreciation. Long-term capital appreciation. Or both. Yes, or both. So, good. So anytime they ask you to define investment property, you combine all these three sentences together. That's the definition. How we get it. So in summary, let's analyze it here. In summary, but for rental or capital appreciation, so rental and capital appreciation. So the reason is this: you acquired a building mainly for rent. So do you need to stay in with a tenant, share the same room? No. So if the room is just the building have maybe 2 offices, you can't share the same office with your tenant. It's unethical to just rent something out and still living with the people. If it's different, like maybe 5 offices, they rented 3 out, left with 2. Fine, that one you can occupy the 2. What you've rented out, you can occupy it in. Good. So that's why you don't need to use it. So it must be vacant before you can give it out. So that is the investment property. So take note of the definition, and then make sure that when they ask you to define, definition or define means give us the excerpt from the standard definition. When we ask you to explain, now we can come with your own words. So these two are not the same. Explain and define. Define word to word, don't change the words. Explanation, you can use your own words. So that is the definition for investment property. So let me ask, can a container or a kiosk be an investment property? Can vehicles be an investment property? Vehicles, no, because vehicle is not a land or a building or a part of a land or both. What about kiosk or container? Can it qualify to be an investment property? Maybe I have some 3 containers somewhere and then 2 kiosks somewhere for rent. Yes, for rental income. Can it qualify? Let's see. We'll look at that in the subsequent sections. So now understand the definition for investment property for us. It's a land or a building or part of a land or both that you acquire not for use or for sale in ordinary course of business, but for what? Rental income and then capital appreciation. Capital appreciation, probably you're waiting. If the price probably appreciate, the land price shoot up, then you sell it at what? Higher price. Let me give you a critical example. No, Pram, they're about to build an airport at Pram. So most of the real estate developers are acquiring large lands there and leave it without selling it now. And they're waiting patiently. The day that they finish the construction of the airport, they will now sell these lands at a higher price. So that one can be classified as what? Investment property. Okay. However, the following are not investment property. Let's take note. We'll list all the examples of investment property. Yes. The lands that are available for sale for real estate developers or buildings that are ready for sale, are they investment property? No. That is inventory, IAS 2. So for the real estate developers, the inventory or the lands or the building that are ready for sale, that becomes what? That's their trading stock. They buy land and sell land. No one manufacture land. They buy and sell the land. So that's their trading stock. Good. So that's IAS 2. However, any land demarcated for rent or for long-term capital appreciation becomes what? Investment property. How do you get it? So those that are ready for sale, they are not investment property. But anyone that qualified, it must have all these features. Good. Then that is it. Great. Let's look for some few examples of investment properties. So the first examples of investment property. Number 1, property acquired by a finance lease and lease out under operating lease. So a property acquired under a finance lease and leased out under operating lease. Okay, so it means that you have acquired a building through a finance lease. Now, under finance lease, the lessee becomes the accounting owner, just to reflect the substance of that transaction. Okay. And then you have also leased it out or rent it out to people. Good. So it qualifies to be personal property. And then land acquired for long-term capital appreciation. How do you get it? And then property lease out or rent out. So property lease out or rent out also qualify to be an investment property. Property lease out also qualify to be an investment property. Now, this example, let me narrate to you and you tell me whether it's an investment property or not. We recently acquired land and then want to construct a new office complex. But we are done with the construction. We don't know whether we should use the asset. We are done with the construction. Everything completed. We can start using the assets. But we have not made the decision to use the asset or to even sell the building. There's no decision. We have just constructed because there was litigation on that land. So if you don't build on the land, the owners will come and take the land from us. So we just put a nice new apartment on it. We can use for office. We can also rent it out. We've not made the decision yet. So, team, can we classify such property as investment property? Or we cannot classify it? Or we should classify under owner occupied? Okay. This will be an example of what investment property. So, building constructed for undetermined use or purpose is also can be classified under what investment property. Because you are not using it, you are not going to sell it. In fact, the decision to use it or to sell it is not even available. So that time it qualified to be an investment property. So you can add it to it. Building constructed and ready, but for undetermined use or purpose. You have not determined the use or the purpose of that building. Good. But you are done with the construction. You are done with the construction. That is it. Now, the standard does not include the following, like the IAS 40. So the following are not what? Investment property. The following are not investment properties. Number one, owner-occupied properties. That's IAS 16. Owner-occupied property. Owner-occupied, that means the owner is living in. So that means it is acquired to be used either for administrative purposes or for production purposes. Good. So number one, that is items that are not what examples of investment properties, owner occupied. So any property, the head office complex should not be classified for investment property. Number two, property held for sale in an ordinary course of business, IAS 2. Property held for sale. So the following are not. Let me write them. Number one, talk about owner occupied. Owner occupied in, right? So owner occupied property. This one is covered in IAS 16, the one that we look at it. Number two, we talk about property held for sale. So property held for sale in an ordinary course of business, like your normal trading, ordinary course of business. That is inventory. So inventories. And which standard talks about inventory? IAS 2. So IAS 2 talks about inventory. And then interest held by a lessee and operating lease. So if you acquire an asset and operating lease and you also rent it out, it cannot be investment property. So interest held by a lessee under operating lease. So interest held by a lessee under operating lease. So under operating lease. Okay, so basically, another one. Forest regenerative nature or natural resources. So like forest. Then biological assets relating to agriculture. And then minerals rights and the minerals reserves. All these are not examples of investment. Then another example, property being constructed for a third parties. We are constructing buildings or roads or irrigation systems for a third party. It's not your own. So before we can allow you to record investment property in your books, you should like own it. You should have the control of the asset. The benefits should move to you before you can record in your book. Therefore, you are the one that will do the construction. That doesn't mean that it belongs to you. So it must flow to the owner. That is it. Then the next one that we will talk about it is property that is leased to another entity under finance lease. So if company A puts a land and lease it out to company B under finance lease, A ceases to be the owner, accounting owner of this building. So what you don't have the accounting owner, you can't record it in your book or in accounting book. That is it. So we are done with the examples and then items that are not examples of investment property. Now let's go to the recognition of investment property. Recognition. Now the recognition of investment property is the same as the recognition of what? PPE. So if you know how we record PPE, investment property too is the same. So here I will be running. So we get to the section where we need little education. So what happened is this. Now the recognition criteria of investment property. Just ask how we should record investment property. Is it revenue, equity, expenses, asset, or liability? So investment properties are what? But they are assets. To be specific, they are non-current assets. So they must be recorded as what? Non-current assets. Good. If and only if the following conditions are in place. What are the conditions? This is our second time of meeting this condition. We are going to meet it again for the third time. So investment property should be recorded as what? Non-current assets if the two conditions, condition number 1 and condition number 2, that is all. So if it is what? Probable that future economic benefit will flow to the entity, that is all. If it is probable that future economic benefits embedded in investment property will flow to the entity, that is all. Condition number 2. If the costs can be measured what? Reliably. If the cost, so if the cost can be measured reliably, and then if it's probable that future economic benefits will flow to the entity, that is the true conditions, then that is all. So get it for us. We are done with the recognition. Then we move on.
The condition
number 2 states that if the cost can be measured reliably. Yes, reliably. So we are done. Now let's go to the measurement. That's where the issue is. So if you don't understand anything, not the measurement. Yes, let's go there. So under IAS 40, I can tell you 2 specific places that we can ask you the question. Number 1, we'll ask you a question on the definition. Number 2, the measurement. Okay. Okay, so that is that. Now measurement. Measurement, there are 2 types. So when I take the measurement, there are 2 types. Number 1, we have the initial measurement, and we have the subsequent measurement. Good. So under the initial measurement, it's the same as the IAS 16. So initial measurement, initially all investment property must be measured at what? At cost. That's all. So initially it should be measured at cost. And the composition of cost is basically the same as the cost under the IAS what? 16. This is the 3rd time for us to look at cost. Because if you look at cost under IAS 2 inventory, cost of inventory. So under IAS 2, we look at cost of inventory. Under IAS 16, we look at the cost of PPE. And again, under IAS 40, we're also looking at cost of investment property. Good. Then that's all. Good. So the cost basically is the same as the cost of another IAS 16, inclusive of cost, which includes the purchase cost, and then it also includes any recoverable purchase taxes, and then development cost. Now, sometimes you need to develop the property before you can rent it out. All those ones should be part of it. However, you don't need to expect something like transportation cost, right? Because don't transport land, don't transport building. It's very good. So because of that, kiosk or container will be qualified. In fact, kiosk or container will be qualified if it is a permanent nature. If you transport it, look at what its quality. And so that is it. Now, exclusion from the cost, startup cost should be excluded. So we go to exclusion from the cost of what? Investment property. Startup cost. So startup cost. Number 1 exclusion, startup cost should be excluded unless they are necessary to bring the property to its what condition necessary for its intended what use, or for the renter, or like how management want it to be, basically. So the startup cost should be excluded, and the initial operating losses should also be excluded. And that's all basically. So we are done with the initial measurement. I'll land on a subsequent measurement. If you don't understand it, no subsequent measurement. Good. But before that, I will say recognition. We said that it should be recorded as what? Non-current asset. So among the non-current assets, investment property will have a 1 line. So like the PPE, under the assets, financial position, non-current assets, you start with your PPE, right? After PPE, you come to investment or property. it's on its own. Do not add it to the PPE because they are different. PPEs are assets that are for use. Investment properties are assets that are for not for sale, not for use, but for rental or for long-term capital appreciation, so that we can classify them differently. All assets that are for use, call them PPE. Non-current assets, call them. If they are tangible, we also have intangible. We also have that long-term investment. So long-term investment. And all these, they are standard talking about this. This is IAS 16. This is IAS 40. This is IAS 38. This is IFRS 9. Talking about this. Good. So all these, all the non-current assets that we see have strong standard that backs them. So now let's go to subsequent measurements. Subsequent measurements. And then you'll be fine of investable property. If you don't understand anything, not a subsequent measurement. Yes. So subsequently, meaning that measurement after the initial measurement. So subsequent measurement of investable property. Subsequent measurement. Now, the entity have to choose between two models. So under IAS 40, the models are number one, we have cost model. Number two, we have fair value model. That is. Okay. So these are the models that we have under IAS 40. Okay, so let me put IAS 40 here. Let me also put IAS 16. What are the two models? Subsequently, IAS 16. What are the subsequent measurements? There are also two. We also have one under IAS 16. So IAS 16, good. We have cost model. And we also have what? Revaluation model. I wonder if we look at this last meeting. So under IAS 16, we look at for cost model and revaluation model. But under IAS 40, we're going to look at for cost model and fair value model. However, there's a good news. The good news is that the cost model under IAS 16 is the same as what? The cost model under IAS 40, so there's no difference. It means that under IAS 16, under the cost model, we depreciate these PPEs. So the same way investable property that are held under cost model should also be what? Be depreciated. That is all. So it must be depreciated over the useful life of the asset. And it must be carried at depreciated cost. That's all. So to get a current value, revisit IAS 16 to give you the formula. The formula is equal to the cost minus what? Accumulated depreciation minus any accumulated impairment loss. That's all. So we are done. However, the revaluation model is the same as what? Fair value model. There are differences. Even though the word revalue the amount can be deemed as what? Fair value. Over here, the two terms are the same. So you need to know the difference and then how we carry the assets. And then I will look out for transfer. And then that is our transfer. I'll look out for transfer. Okay, so let's quickly look at the game. So now, under IAS 40, we call it fair value model. Under IAS 16, we call it revaluation model. revaluation model. Now, when they ask you for the difference, don't tell us that, oh, one is an IAS 16 and one is an IAS 4. This is IAS 16, this is IAS 40. No, don't tell us that. Now, I will add to the question itself. So let's look at some few differences and back this difference with illustration. So I'll solve two, after the differences, I'll solve two questions and then we are out of IAS 40 and start different standard. Okay, so let's see. So the difference between the revaluation model, so the difference between the revaluation model under IAS 16 and fair value model under IAS 40. Good. What's the difference? So I'll give you 4 of these differences, and then you look out for the one. At least you should know 5 of them. So after my 4, then you look out for 1. And those that will add the 1 will smile in the exams. Those that will add the 1 will smile. Okay, so over here, the name is called, let's start with the revaluation model. Revaluation model is under IAS 16, agreed. Over here, let's call it fair value model. It's under IAS 40. This is the differentiator. Number 1, please don't say that one is under 16, one is under 40. Don't say that one is called revaluation model, one is called fair value model. No, these are not differences. Yes, these are not differences. We are begging you. These are not differences. We are looking for the treatment. How the treatments are what different from each other, like the treatment of investment property or treatment of building that are like building that are carried under IAS 16. How we treat them? How is it different from buildings that are carried under fair value model according to IAS 40? What's the treatment? So it's about the accounting treatment, okay? Not about the names. Good. So number 1. The first one is depreciation. How we depreciate the items. So depreciation. Under IAS 16 revaluation model, yes, we depreciate the assets. So yes, there's depreciation. So we depreciate assets that are valued under the revaluation model in accordance with the IAS 16. What about fair value model? No depreciation. Wow. No what? Depreciation. So property that are carried under the fair value model, according to IAS 40, you don't charge any depreciation. So that is it. How to get a difference? Good. So when they give you an asset and it's being carried under the IAS 40 and it's an investment property, then don't charge any depreciation on that asset. Difference number 2, how we find the carrying amount of the assets. How do you find the carrying amount? Carrying amount. See, carrying amount. How do we determine the carrying amount? And a revaluation model. The carrying amount is equal to the revalued amount is equal to revalued amount less subsequent accumulated what? Depreciation and subsequent accumulated impairment loss. That is under what? Revaluation model. Under revaluation model. The revalued amount less, this one is less, have you seen? Okay, let me do this way. Less subsequent accumulated depreciation. Now, under the fair value model, the current amount is always equal to the fair value at the end of the reporting period. So it's equal to the fair value at the end of the reporting period. Reporting what? Period. That is all. So fair value at the end of the reporting period. That becomes the current value. Let's go to point number 3. Changes in the fair value. How do you record it? Changes in the fair value, meaning the revaluation differences. Where do you record them? So let me do little. I can get space. I'll copy the full version, right? So changes in fair value. Now, changes in the fair value. Under the revaluation model, we report gains. Gains move to OCI, right? And then losses move to the P&L. So that is under that gains reported in where? The OCI. The losses are reported in the P&L. That is all. So revaluation gain being reported in the OCI. Other comprehensive income. Other comprehensive income. Losses are reported in the P&L. Good. Now let's go to the fair value model. Under the fair value model, all changes are reported in the P&L. So both gains and losses. So all. So both gains and losses are reported in where? P&L. All of them go to one place. That is all. Now, I'll give the last feature or the last distinguished factor, then we proceed to solve our question. Now, the next one that I'll talk about is the asset, the type of asset. So type of asset. Does it qualify for all assets? Type of asset. In fact, revaluation model can be applied to all assets. Revaluation model can be applied to all assets, right? All PP. So all assets, whether land, whether building, whether plant, whether intangible, apply. But fair value model, IAS 40, in fact, it only applies to land or building. As usual, the thing must be qualified. It only applies to investment property. How do you get it? It only applies to investment property, like land and building. Okay, so basically, that is the game. Okay, so look at our first illustration. So aside some IAS example on the board, and then we look at for. Okay, so let's take this nice illustration. I'll solve two questions here. From there, then I'll move on to the last aspect. Then we proceed to the next standard. Okay. So next is the first example. So let's take this example. I'll not talk plenty. I'll go straight for it. So on, let's say, 1st of January 2010, ABC acquired. Okay, so on this day, ABC PLC or ABC Limited acquired a property at a cost of uh, 80,000 cedis, at a cost of 80,000 cedis. So with a useful life of with a useful life of 10 solid years, 10 years, at which it will be disposed for an amount of 8,000 cedis, an amount of that. Okay, yes, 8,000 cedis. So stop. How we get a question? Good. Second paragraph. The property was rented out immediately, rented out after its acquisition. For rental charges or a fee of, let's say, 12,500 cedis per annum. Per annum, full stop. Per annum, full stop. The last paragraph. The fair values of the building as at the end of the first 3 years are as follows. So the fair value of the buildings, the fair value of the building at the end of the first 3 years are as follows. So fair values of the building, of the property at the end of the first 3 years. So let's start. As at 31st December 2010, the fair value is 75,000 cities. 75,000 cities. As at 31st December 2011, the fair value shoot up to 90,000 students because of an increase in general price level. As at the end of 31st December 2012, the fair value also dropped to 85,000 cities required. Account for the above transaction in the book of ABC Limited for the first 3 years. So, 31st December 2010 and then up to 12. Let's take it again. Required. Account for the above in the books of ABC Limited. Account for the above transaction in the books of ABC Limited. For the year ended 31st December 2010, 2011, 2012, and show the relevant extracts from the financial statements. So I'm going to prepare the relevant extracts from the financial statement. Okay, so let's summarize the question. The question is into 3 paragraphs. Paragraph 1 is saying that the guy acquired, they are just giving us the general view. The guy acquired assets, or the company acquired assets, property, okay? Property meaning that it's made up of land or a building. So that one, they don't need to clarify it again, property. Except for otherwise today. The cost is 80,000, okay, that's fine. It's for life in 10 years, okay, depreciation. At which it will be disposed of for 8,000. So that becomes what? Extra value. Okay. So that will affect depreciation. Good. Then, second paragraph. The property is rented out after 8 words acquisition for 12,000 per annum. So it was rented out. So that's the rental charges. That's the rental income. So it makes it what? IP. As at here, it does not make it IP. How we get it? Because for investment property, that's the IP. One, after being land or a building, you must move ahead for its rent or the capital appreciation. And that was the one that was second paragraph. So second paragraph, make it clear that this property is what? An investment property. The first one does not make it clear. The mere fact that you've acquired property does not make it what? An investment property. It will become an investment property if you are renting it out or you are not using it. How we get it? So let's take note of that point. So this makes it an investment property. This one just makes it a mere property. A mere property. And this one makes it an investment property. Good. Then the last paragraph, that's the fair value at the end of the first 3 years given to us. That one is just the measurement. So let's start. In fact, the requirement, add this one to it, an above model, cost model and revaluation model. So the requirement, we are solving this under cost model and under what? Revaluation model. Good. So that is it. So first thing, now we are going to look out for under cost model. So I hope you have the details. Okay, I remember the details. Under cost model. So A, cost model. Cost model. So I'm calculating for ABC PLC how the P&L look like. The first 3 years, so 31st December 2010, 2011, and 2012 extra. How the P&L look like? Okay. And how the financial position look like? Where you have the question? Yes, I remember. Oh, okay, I remember. So, and then the financial position. How you record a full version, statement of financial position as at. That's what like this too. Okay. Now in the P&L, the first thing I will look out for is the depreciation. Because investment property valued under what cost model need to be what depreciated. Let's come in and write depreciation. How do you calculate depreciation? Open a bracket. What's the cost of the asset? 80,000, right? Minus the scrap value of 8,000. All divided by what? 10 years, right? Good. So that's the useful life. So this will give us 72,000 divided by 10. And that will give us 7,200. The depreciation will be 7,200 for all the 10 years. 7,200. That is all. Then second, there's a rental charges, right? The rental is other income. So you go to other income and you record 12,500 as what? Again, to the company. So this one, I'll put this one in bracket like this nicely. Let me stream here later. Okay, so I'll go to other income and record rental charges. We are receiving the amount, and that's 12,500. 12,500. Good. So this is how the P&L will look like under the cost model. Let's go to the financial position, the balance sheet. On the balance sheet, all what you need to do is to look out for the carrying amount of the property. That's all. So if you can find the carrying amount of the property, that's what we go to there. So let's see the cost of the property. The cost of the property will run through 80,000, 80,000, and 80,000. Then we go to the accumulated depreciation of the property. The first year is 7,200. We take it off. The second year we add, so we get 14,400. Then you get a current amount. So current amount. Then you double underline it in that order. So the same thing, you come here, add 7,200 to this, I get 21,600. If you take it off, now get a current value. That is all. So this is how the cost model will look like. Have you seen that there's fair values given to us in the question? We have pretend as if we've not seen that PS in the question. That's how it's supposed to be. So don't touch it at all. If you're using the cost model, the fair value needs to be disclosed in the footnote. That's all. We don't touch the fair values. So not because they are giving it to us, we must touch it. No. It must be a policy. So we are down with the cost model. Again, let's look for the fair value model. Let's go and look out for the fair value model. Fair value model. Fair value model. Fair value model. Okay. So all what I'll do is this. I'll just change this one to value. Claim this one from there. Right, I'll clean everything. I'll clean everything. First, Under the fair value model, we say no depreciation, right? We don't depreciate investment property held under fair value model. So no depreciation, agreed. Good, so there's no depreciation. So the other income, we have to cut it in. So other income. In the other income, we'll first of all have the rental charges. Which is 12,500, which is again must be added to other income. If you check the question, it might be in the trial balance, the rental charges. If you check a question like we are done and finished it was in the trial balance at the credit side. In fact, one of them was 3,000, one of them was 360. I think we are done is at 360. And finished is at 3,000 on the trial balance. Okay. So that's the first thing that we record in the P&L if there's rental charges. What if maybe it's not for rental, but just for capital appreciation? Okay, then no rental, so that one, nothing comes in. Dash. Then we go to our financial position. The financial position. Then at the end of the first year, at the end of the second year, third year, don't forget that this asset will last for 10 years. We only do the first 3 years. The rest is not part of the requirement. In fact, in some situation, they will ask you only the first year. Do only the first year. That's why the rest is not part of the game. Now, I record investment property here. Investment property. The name. So I record investment property. We said that investment property held under fair value model need to be carried at what? The fair value at the end of the reporting period. I agree. So that was the second point that we stated under the differences. So what's the carrying amount? It's the same as the fair value at the end of that period. So what's the fair value at the end of 2010? Good. So 75,000. So that's the fair value at the end of the first year, 75. Good. Then you go to 2011. What's the fair value there? 90,000. And again, it dropped to 85,000. So the fair value, however, these fair values in the publication, it will be under the footnotes, among the footnotes, not in the trial balance, the fair value in the reporting period. Now, then we go to the last section. It says that the changes in the fair value should be reported in where? The P&L. No OCI matter here. No OCI. OCI is for IAS 16. Good. So, fair value gain or loss. So tell the examiner that fair value gain or changes in fair value. Fair value gain or loss. So you compare, how to get a gain? Compare two items, the opening balance to that of the closing balance. So let's take 2010. In 2010, they acquired the asset for how much? The original cost of the asset is 80,000. But at the end of the reporting period, the fair value is 75,000. So there's a loss of what? 5,000. So I come here and put the 5,000 here in brackets. Then I'll go to 2011. What will the opening balance in 2011? Good, opening balance becomes 75,000 and closing balance is 90,000. Good. So there's been a gain of what? 15,000. So it'll be 15,000. Then finally, when I go to 2012, opening balance becomes 90,000, right? And then there's a fair value of 85,000. So there's a gain of what? Okay, a loss of 5,000. So 5,000 will be here as loss. Now, all the closing balances will be in a footnote. The opening balance on the trial balance. So take note. Closing balances are what? To be among the items listed in the footnote for you. But the opening balances are in the trial balance. And then we pick them. Then we move on. So I'm done with the first illustration. I'm now going to do the last one. So the one that you are trying for me is you are trying question number 4 and question 5 from the material. Question 4 is we are done. Question 5 is finished that. You try them for me and tell me how it has been recorded. In fact, this calculation here is not part of the financial position. It's on its own. It's working on its own. Okay. So working on its own. Great. So now let's back with what for the illustration. Going through, we are done. That is question in here. We are done. We are done. Now let's go to note number. So let's all turn to note 4. Yes, for we are done. Note 4. It says that the company uses the fair value model of IAS 40. Once it mentioned fair value model of IAS 40, it tells us that we should not depreciate it and then apply all the requirements. So use the fair value model. The fair value of the investment property as of 31st December 2019 was 8.92 million. So how do you treat this? Meaning that you have this is the closing balance of the fair value. So you have to compare this and the one on the trial balance. If there's any change, send it to other income. If it is positive, it again add it to other income. If negative, either you subtract or you can add it to the operating expenses. That is all. How do you get it? So let's go to the trial balance and go and check the opening balance. In the trial balance, investment property, right? Sure. It's 8,700 here, right? When I go down, the fair value at the end is 8,920. So there's a gain. There's a gain of 220. So this gain should be reported in other income. That is all. Then it's continue. Let's continue the notes. However, rental income of 0.3 million on the investment property has not been received, but the company reasonably expects to receive 75% of this amount. So add it back. So you find 75% of 0.33 and add it back to the rental income on the trial balance. Let's go to the trial balance again to look for the rental income. So 360. So that one should also be added to what? Other income, plus the one that they've not received. That will be 75% of the 0.3 million. So this one will be added back, and then that is all. So I'm done with the fair value model and its issues. Now what you have to do is you are trying to finish that. Let me go to my last section of the standards, and then I'll run away to the next standards. Then we see the way forward. Now the last aspect of this will be transfers. Very important, transfers. I'll do the transfers at the question solving stage. Transfers at the question solving stage. Transfers. Right from transfers, then we go to the derecognition, and that's the end of IAS 40. Transfer simple means number one, you can transfer owner-occupied property, owner-occupied, or you can transfer from, let's say, PP to an investment property. For example, the head office building that we have used for over 10 years. We have recently built a new head office and we have moved to the new place. So our old head office, or the existing ones, became vacant. So we decided to rent it out. So now it has moved from where? PP to investment property. Or the reverse is also true. Some apartment that we've given it out for rent for several years, we also decided to call it back and occupy in immediately. So we can also move from investment property to what? PP. So these are the transfers. Number two, transfers. You can transfer from inventory to investment property. The reverse is also true. I'm selling some building or some land. In fact, I've marketed that nobody is buying the land. Eventually, we occupy it by ourselves because they say will not buy. If we don't buy, we have to use for ourselves. That's all. So the inventory, the land and building that are ready for sale, we've done advertisements several years. Nobody is buying this land and building. So we also decided to like rent it out. Have you seen? So owner occupied, like if we use it, it becomes owner occupied. So we decided to rent it out. If they're not buying, they can rent it. So rental charges, then we start receiving some rental charges. Or we left it. We said, no, we are not going to sell it again. We are waiting. A time will come, you now will come for that land. And true. Yes, they'll come for the land. Or we have some, like the example I gave, that they're about to build a new airport at Kampram. So some of the real estate developers have acquired huge lands there and holding it for investment property or investment potential. They're not selling it now. So now it's not for sale. A time will come after the construction of the airport, they will now move it from investment property to what? Inventory. They're not selling it. How we get it? So this is the transfer. Good. This one came for that of the ICAS. That's last two settings exams. Then number three, this transfer, very important. There's a transfer between cost model and the fair value model. The reverse is also true. I have investment property. At point in time, I'm using cost model. But after a few years, I said, no, I want to use fair value model. So I made a transfer. And then the reverse is also true. Perfect. The last one will be like this, number 4. But that one, it does not move. It's not under the IAS 40. It's like this. It's a transfer like PP to inventory. And the reverse is so true. This one is not, does not fall under the scope of IAS 40. So only this. So I just pick one example under the PP to investment property, and then I'll run away from there. Okay. So I'll explain these two. They are the one that we have to look at them carefully. These two. PP to what? Investment property, and then investment property to PP. The reverse is true. Okay. Now, how do you account for it? So I'll give you the steps and the procedure for. Let's assume that it is PP to investment property. That's the common one. PP. So transfer PP to what? IP for the treatment. Now let's go to accounting treatment or the small line. Let's assume that our financial year end on December. December. Let's just assume that the transfer took place here. This is where we transferred it. So January, the asset was still with us. The transfer took place, let's say, this should be 4 months. This should also be 8 months. 4, 8. Okay, so 5, 7. So at the end of May ending. So May ending, the last day of May, we decided to transfer the property from PPE to investment property. Now, look at the steps carefully. So that means between January and May for the same year, the building was PPE, agreed. It was PPE until the transfer took place. So here is PPE. So it must be depreciated between this period. So from here to here, May, 5 months. So charge 5 months depreciation. How we get it? So 5 months depreciation. If it is 6 months, 6 month depreciation. So the number of months within that year that takes you before you make the transfer. Then second, at the date of the transfer, two things should happen. Can you calculate the carrying amount at the date of the transfer? And here, we will tell you that under the investment property, we are going to use fair value model to work the case. Okay, so at the date of transfer, determine the fair value of the property and compare the carrying amount and the fair value. There will be a gain. That gain should be reported in OCI. So any fair value gain at the date of the transfer, fair value gain at the date of transfer should be accounted for under what? OCI using IAS 16. Wow. You are doing IAS also. You have to use IAS 16 revaluation model to account for any change or any gain or loss. Let's say the current value is 30. Fair value is equal to 45. So there's a gain of 15 must go to OCI. Now, how do you calculate this current value? It's equal to the original cost of the assets. Current value is equal to cost of the asset minus accumulated depreciation up to the date of the transfer. That is all. And we are done. Then we've now officially or properly usher the building from PPE to what? Investment property. So now from here going. Okay, so we have fully ushered the building into what? Investment property. So from here going, it is IP. And you know, and a fair value, no depreciation. So the only depreciation for that particular year will be the period that the asset was PPE. That's the only depreciation. No depreciation when the property becomes what? An investment potential. That is all. Then at the end of the reporting period, something will happen. They have to also tell us the fair value at the end of the reporting period. So let's say the fair value at the end is 50 Ghana. So, okay. So at the end of the reporting period, the fair value, let's assume that has moved toward 50 Ghana cedis. So now, we need to also compare the fair value that was here, which is the 45, against what? The 50. So now these two treatments, in fact, you have to use red pen and repeat this section over and over 10 times. So 1 and then the 2. We have fair value 1 and fair value 2. Now the second one is a fair value gain at the end of the reporting period. So at the end of the reporting period, any fair value gain, so we say fair value brought forward or at the start is 45. At the end is what? 50. So there's a gain of 5. This 5 should be reported in the P&L. This one should go to P&L. This one is going to where? OCI. So fair value 1, go to OCI. Fair value 2, go to P&L. That is all. This side, kindly. So this is fair value gain. Because at this time, the asset has been fully assumed investable property position. That is why all gains on investable property should be reported at where? The P&L, all gains and losses. But here we have not fully ushered the asset. That's why any gain or loss should be reported under OCI. We've not fully ushered the building into an investment property. We are now doing the rituals to convert the building from PPE to what? Investment property. So by that, and now we can't tell ourselves fully that this building is what? Investment property. And that's why any gain or loss should be reported to OCI. That is all. So it should be reported under IAS 16 revaluation model. So that's the end of the treatment. Then OCI is under P&L, but there's a slight difference between OCI and P&L. Let me do the illustration. Good. When you take P&L, for instance, we are current comprehensive income. From sales revenue up to the profit after tax is the P&L. So items from sales revenue up to profit after tax is what? The P&L. This is the P&L section. It is materially different from OCI. They are not the same. Even though they are under the same umbrella, they are not the same. They are under the same headings, but all of them are different. So from profit, sales revenue up to profit after tax is the P&L. Then the OCI is on its own. So this is OCI, they are on its own. So even though they fall under the same headings, in fact, they are two different things altogether. They don't have the same treatment. So that's why this one goes to OCI, this one goes to P&L. So this one will go to P&L, meaning that this 5 will be reported in here before the profit after tax. And this 15, the 15 will be recorded the OCI as fair value gain. So in this particular question, in our P&L to look like this. So if this is a comprehensive income, I'll go to other income straightforward. That examiner, fair value gain on IP, investment property. This one, the 5. And when I go to OCI, that examiner, revaluation gain. Before the building was ushered into investment property, it is 15. I'm missing. These treatments are not the same. Yes, one goes to P&L, one goes to OCI. So OCI and P&L are not the same item, even though they are the same building. I'm missing. No wonder if you come to Ghana, OKFM, NIT FM, and Peace FM, and the same word building, but they operate differently. So this is the same thing. Okay. Great. So that's the end of the game. Now the transfer from the other ones are not difficult at all. For instance, if I transfer from PPE to investment property, here cost model, here to cost model, you've not done anything. That is not that you've not transferred anything. Because cost to cost, I'll still continue. That the answers will be the same, do not change. Do not change the impact to do the calculation from cost to cost with depreciation. So it will continue depreciation for you, which will be the same as like if I should have carried them at PPE. Yes. And I'll give you an example. So if an old person died and then you treat the old person by another old person again, you not perform the funeral right to know. You just postpone the funeral. How we get it? Exactly. So cost to cost, not anything. You just postpone the accounting treatment. That's all. Now we can also have cost to fair value model. Yes, you done something. That's what you are doing. Then you can also transfer from this to this, and then that is all. You can also move from revaluation model to fair value model, and then the reverse is also true. That is all. I'm done. Now let me quickly hit on this, then run away. Derecognition. With the derecognition to the asset need to be derecognized from the financial position if the future economic benefits cease to flow to the entity. The same as what we did under the PPE. Good. So to amount to disposal. So how do you dispose of property? So disposal. So disposal. You compare the proceeds to that of less the carrying amount. Take note that the carrying amount to be affected which model you are using. If you are using the cost model, it must be depreciated. How do you get it? So the carrying value depends on the model that you are using. If you are using fair value model, just pick the fair value. And that is all. Good. So basically, so we are done with the game. If it's again, go to P&L. But if it's again the same place, so other income. If it's a loss, you go to operating expenses and then down again. So on that note, I'm done with IAS 40. Let me back with what illustration. Let me quickly go to this particular question and then you try them for me. So let's go to okay, so you're trying illustration 1, illustration 2, but then illustration 3, or other illustrations. Good, illustration 4, but kindly let me have your version of illustration 4. Great. Illustration 4 is the leader. Great. So now let's get done. Now I'll scan through more of IAS 20 government grants. So IAS 20 government grants. So government grants and disclosure of government assistance. So all right, some few terms. I'll go straight terms. You should know the governance that you're talking about here. Number 2, government assistance. Then number 3, you should know grant. You should know the type of grant and then the treatment. That's all. So let's quickly now government grants. First of all, we look at government. What is government? But here we don't want the Abraham Lincoln's definition. No. Here, government refers to government, both central and local governments, and any other institution, like both local, international, and that is all. So government refers to the governments both local governance and central government, central and local government. Good. And 8 agencies, so both local and central governance, and 8 agencies, and similar bodies, local, national, or international. Okay, so I've got a definition for government. In fact, it means national, international, or local. That's all. So in UNESCO, according to IAS 20, it's a government, but it's a similar body that like operates internationally. Now let's go to assistance, government assistance. How is it different from government grant? These two terms, assist and grant, are they the same? Assist someone and grant someone a chance. Okay, I'll take that. Now, when you talk about government assistance, it refers to actions designed by the government to provide a support or an economic benefit to an entity qualifying under certain criteria. Good. So it's an action designed by who? The government to support or provide economic benefits specific to an entity qualifying under certain criteria. There's nothing for free. You must qualify for the government to assist you. So it's an action by the government or designed by the government to support or provide economic benefits to an entity qualifying under certain criteria. That is the government assistance. Okay. Now what happened is this. Qualifying under certain criteria. You must fulfill the condition for the government to support you. There's no free shop anywhere. Okay, so let's see. Now, assistance is just a mere support given out by the government to the entity. Then what about grants? I'll give you examples of assistance. Assistance like grant of local operating license. Good. Permit. And then like quota. Let me give you 2 real life examples. Let's assume that we are the manufacturers of local rice. And then government passed a law that no one should import rice into the country. The government have assisted us. But it's not giving us the money, right? It's not like in the form of monetary compensation, but this, it will boost our productivity or our operations. Good. Example 2. Want to go and then plant, let's say, cocoa on large scale or cashews, and we need a license. I want to buy and sell cocoa, or let's say gold, we need a license. Instead of using, let's say, 3 solid months to acquire the license. The government say, oh, this area is on my heart, so don't worry. Just the first day and give them license. Just the first day and give them what? The license. Government have assisted you without the license. Good. Let's go to government grants. Now, grants. For the government grant, in fact, that one is the form of assistance, like supply of what? Resources. So grant just refer to supply of resources. Supply of what? Resources. Or the assistance in a form of supply of resources. Government grant, that one, I would say that it's a special assistance. But in this case, the government will do what? Transfer a resource or transfer something to you. Assistance, government won't transfer anything to you. Grant, government must give us something. Good. So that is the difference. So grants are like assistance by the government in the form of what? Transfer of resources to an entity in return for past or future condition. Future or condition, like compliance with the future condition. You know, there's no future up anywhere. So either you have already complied with the condition before we give you the grant, or we will give you the grant and then you comply with the condition in the future periods. That's all. So let me take it over again. Grant refers to an assistance by the government in a form of what? Transfer of what? Resources, right? Good. To an entity in return for past or future compliance with conditions or certain conditions. Certain conditions. There's no future anywhere. Yes. Return for past or future compliance with certain conditions. With certain conditions. That's all. Okay, so that is the definition for government grant. So now with the grant, either we are giving you something or we are buying something for you. But the assistance, we are not giving you anything. We are going to use our power to help your business go faster. That's all. That's the assistance. How we get a difference, right? So that's a thin line or difference between grant and assistance. Okay, what about aid? How do you classify aid? So will aid be a grant or an assistance? Aid. Grammatically. Good. That is that. So aid would be an example of grants. Now let's look at the accounting treatment and then the type. Good. So there are two types of grants. We have grant that relate to income and grant that relate to assets. I'll talk about them. That's the last aspect, the types. Before that, let's look at the recognition criteria for grant. Meaning that how do you record grants? Now, the recognition criteria is based on two conditions. So before you record grant in the books, make sure that two conditions are in place. Two conditions. If these two conditions are not there, please don't record a grant. Condition number one. The money will be received. That's the first condition. Make sure that before you record any grant, make sure the money will be what? It's not a mere promise. So mere promise should not be recorded. So before you record a grant, condition number one, make sure that the money will be what? Received. The money will be received. Number two, the condition will be fulfilled or satisfied. Yes, before you record the grant in the book, make sure that you can fulfill all the grant conditions. I will get it. All the conditions. That is all. If these two are in position, then record the grant in the books. No, you can record a grant whilst you have not fulfilled the condition. But assessing your activity, say yes. For now, there, I've not fulfilled any, but in future period, I'll fulfill the condition. So that one, go ahead and put it in. Good. Now we are done with the condition. I'll go straight to the accounting treatment and run away again. And there are two types of grants. We have grant that relate to income and grant that relate to assets. I'll start with the income only. Grant that relate to income. You can also call it revenue grant. Grant that relate to what? Income. So types of grants. Number one, grants related to income. It's also called revenue grants. Accounting treatment. This type of grants need to be recorded or recognized in the books as and when the condition is being fulfilled. That's all. Grant. The first type, grant related to income. But the second type is grant related to assets or capital grant. I want to treat the revenue grant first. It must be recognized or recorded in your books as of when the condition is being satisfied. So if this total sum or the funds or the money has been received ahead of the condition, then the entire money should be recorded as a liability to the organization. As and when you fulfill the portion, then you released its equivalent to your income statement as a gain. How we get it? Let's start the whole illustration again. The first one says that it must be recorded or recognized as and when you fulfill the condition. So you cannot take a record of the grant like a game of it if you have not fulfilled the condition. How we get it? Good. What if you have received the money but you have not fulfilled the condition? That one you release it to a liability. It must be treated as what? Liability, because you're owing the government a condition. So as and when you fulfill the condition, then you release it from the liability to what? Your income or your other income, and that is all. Now this type of grant, it is for the operating costs of the entity. So if the government supports you with the operating expenses, we call it what? Revenue grant, or this grant relates towards income. Oh, employee, let's say 500 or 1,000 new staff and get 1 million Ghana cedis. So this type of grant is called revenue grant or yes, operating certificate for operating cost. So any money that the government will give it to you to support the operating costs, we will call it what? The revenue grants. Good. Basically. So that is it. Now the accounting treatment, I'll place them there. So there are two situations. Number one, where the condition has been fulfilled, and number two, where the condition has not been fulfilled. So at the time of the money, or at the time, at the end of the financial statement, like the reporting period, have you fulfilled the condition, or if not fulfilled the condition? It will determine how to treat the grant. How do you get it? So let's see where 100% condition has been fulfilled. So if you have fulfilled 100% condition, so where 100% is being fulfilled. You are done. If I say employ 505, you employ 600 in addition. You are just waiting for the money to arrive. Oh, they say just operate in this just one local community, you are fine. But you're in all over the communities, you're just waiting for the money. Yes. How do you account for such grants? When you are done with the condition. Good. So that is treatment number 1, and then number 2. First of all, if you have received the money, add the money to your cash, because now you can take a cut of it. So add to your cash. So add to the cash or your bank balance, cash or bank or cash book. In bracket, that is the debit side. What if you have not received the money? So you add it to your current asset as grant worth receivable, as part of your grant receivable. So in brackets, receivables, if you have not received the money, but you have fulfilled what? 100% condition. A typical example is in Tokyo.
When the money is received, you add it to the cash balance. It is a debit side.
Application. So the debit means you are debiting what? The cash. And then you treat as receivable if received. So if you have not received the money, go to current asset and add it to your receivables. That's all. Treat on its own. It's a special type of receivable. So treat on its own. That's all.
If you have not been received.
Good. If you have not received the money, but you have fulfilled the condition, all the conditions satisfied, you are just hoping that the grant will be released to your account. So because you have satisfied all the conditions, now you can take records of it. So you add it to receivable. Good. Now let's go to the B, the second treatment. Okay. And then you add it to your other income, because if that's the presentation. In fact, the IAS 20 give 2 presentations. This one is the second one, meaning that we are taking credit of the grant. Or you can also net it off from the related expense. Good. So add it to other income, or you net it off. So this is the second treatment. We add it to other income, or you net it off. You subtract from the related expense. Maybe it's related to operating expenses. When subtract from operating expenses, that's the alternative. The standard IAS 20 prescribed 2 accounting treatment. Either you take records, you record it on its own and under the other income, or you subtract from related expense. That's all. Now let's go to the second one, where the condition has not been fulfilled. It's not satisfied the condition. In that case, in fact, they will even attempt to give you the money ahead of time. Okay, so where you have not fulfilled the condition, where the condition is satisfied on a gradual basis, like bit by bit. So where 100% condition has not been fulfilled, where 100% condition not been fulfilled. Okay, it's not been fulfilled. Let's do something. And the money has been received. They've given you the money. That one, yes. And you have received the money. You have not fulfilled any of the conditions, or you fulfilled just a portion, but they've given you the entire money already. So for instance, employ, let's say 50 new staff over the next 3 years, and then we'll give you a grant of, let's say, 25,000 cedis is for you. How we get it? So let's see. Let's assume that this is the year 2 and the year 3. Year 1, you try your maximum best. You had only 20 employees. You employ only 20 employees. And then year 2, you did well. You had 18. Year 3, you employed the remaining 12. Have you seen? So it can even happen that year 3 didn't employ anybody. That you are still only for 12 employees. So it will happen. How do you account for such transactions, such grants? Where the condition of not fulfill the condition at the goal or at the time. So piecemeal, gradual, small. Like how we learn, how we prepare for exams. All examination is on piecemeal, small, but then you finish, but now everything. Let's look at the accounting treatment. Number 1, the first treatment. At the inception of the grant, meaning the first day they give you the money, 2 treatments. So at the inception, so on the receipt of the grant, the first day the government gave you the money, that one is not fulfilled any of the condition. So 2 treatments. Number 1, add it to your cash. Because you receive the money. If you don't add, the cash will be hanging. So add it to cash. So add it to your cash balance or your bank balance. Usually it's in the form of check. Number 2, add it to a non-current liability. We call it deferred grant. Add it to non-current liability. We call it deferred grant. Why non-current liability? Because you have not fulfilled any of the conditions and wait for 3 years. That's the first day the government gave you the money. So at the inception of or at the receipt of the money or the grant. B, let's go to at the end of the reporting period. So at the end of what? The reporting period. So at the end of each reporting, what do you have to do? So at the end of the reporting period, 2 things will happen. So the proportion or the part of the grant that you fulfill, the condition that you fulfill, calculate its equivalent to what? Revenue or its equivalent income and 2 treatments. So at the end of the reporting period, an amount should be released equivalent to what? The proportion of the grant or proportion of the condition fulfilled. Okay. Now, how do you release it? How do you release the portion? So 1, you add to that of your other income, to add to other income, the portion that you have fulfilled. So calculate the portion, add it to your other income. How do you get it? So let's say, at the end of year 1, I was able to employ 20 staff out of the 50. So I'll calculate the equivalent revenue for 20 staff. If the entire 50 staff, they are giving me 25,000 and I've employed 20, so what's the equivalent amount? So I'll tell the examiner that, it is 20 out of 50 times what? 25,000. So this will give me, that'll be around 10,000, eh? So 10,000. So that means at the end of the first year, I can only record 10,000 as my what? As my income. Then at the end of the second year, I can take 18 out of 50 times the 25,000, and that's what I can also release. Then the last year, I'll take the 12,000 if I fulfill all. So I'll add it to other income. Then second, I'll subtract it from the non-current liability. Good. So the 18,000, that one, we had 9,000. So it means that the 12,000 out of 50, that will be 6,000, right? Good. So I'll add it to the other income and then subtract it from non-current liability, meaning the deferred grant. That's all. Yeah, done. So in this case, this is how the P&L look like. And I'm down for that one. I'll click it on capital grant and run away. So in that case, the P&L will look like this. Financial position to look like this. So how many years? 3 years. So year 1, year 2, and then year what? 3. I tell the examiner other income and record grant. So if I put a grant here, I know the first year I earned 10,000. Okay, I'll put a 10,000 here. I'll go to non-current liability. Grant, deferred grant. So deferred grant. The entire grant is what? 25,000. So, but at the end of year 1, I've released what? 10,000. So I love it. So I'll subtract this 10,000 from the total grant. That's the total liability. So that is 15,000. So means I'm owing a condition of 15,000. Then I'm done. The next year I release another 9,000 to the P&L. That's good. Meanwhile, now I left 15,000 for me to release. So now I left that much, 6,000. So, and I release that one here. Do I owe the government? No, I don't owe the government. What if at the end of the year 3, I employ only 6? Only 6. So that means I can only release 3,000. And I will still owe the government 3,000. Okay, so we are done with that of the revenue grants. Let me hit on capital grants or grant that relate to assets. And then let's look at the game. Capital grant or grant related to what? Assets. This grant, the one that, and then that will relate to what? Income or relate to an expense. Let's see. Capital grant or grant related to assets. Capital grant or grant related to assets. Here, it is a grant that you receive to acquire assets. Two things: either the government is giving you funds to go and buy assets, or they are giving you the asset. You go and buy the asset and give it to you. Okay, so that is the two. Now, the capital grant, there are 2 types of the treatment, and that is all. First treatment, or treatment number 1 and number 2. Number 1 is called deductive method. Deductive, as the name suggests. Deductive method. Treatment number 2, deferred credit. Deferred credit method. Okay, so I'll start with this how, and I'll go to this, and that's all for game. And then we'll start solving questions on this. So let's start with the deductive. Under the deductive method, let us remember that the entire grant will be subtracted from the cost of the asset and depreciate the remaining balance. That's all. That one, the costs, the grants will be subtracted from the cost of the assets and depreciate the remaining balance. Depreciate the remaining balance. Depreciate the remaining balance. That's all. So let's back with illustration and run away. I'll not talk plenty. Let's assume that you want to buy an asset, the cost is 100,000. Let's assume the cost is what? 100,000. Let's assume that government is also giving us an incentive to buy these assets. Government is granting us 40% of this money. So we should pay the money balance. And then the useful life of the asset is 4 years. This asset lasts for 4 years. Okay. Right, let me write this one. Only here. So the original cost of the asset is equal to 100,000. Grant received. Government said that it will support that with 40% of the amount. Fine. The assets originally have a useful life for 4 years. Okay. What again? I bring scrap value later. Scrap value does not change any of the calculations, still the same. There's a scrap value. And the deductive method, what are you going to do? First then, and the deductive method. So using deductive method. First, and then entire grant needs to be subtracted. So let us the original cost of the assets is what? 100,000, right? What the grant received? 40%. So 40% of the amount becomes what? 40,000, right? You take it off 11 with what? So it's the same as we taking the 60. So we call it net amount. Let's calculate depreciation. What will be the depreciation? It's a 60,000 divided by what? 4 years, right?
It will be the 60,000.
Yes, not the original cost. So we said that subtract the entire grant from the cost of the asset and depreciate the remaining balance. Good. Now, here and there, the government will pay 40,000 for you. You paid only 60,000. So depreciate what you pay. How we get it? Don't depreciate the government for. So depreciate
the 60,000.
The 60,000. What? So depreciate the 60,000. What company actually paid? So that's the deductive approach. So subtract the grant from the original cost and depreciation will be. So let's see. That one, the P&L will look like this. Year 1, year 2, year 3, and year 4. So in that case, don't forget the name of the company or the other protocols. Depreciation will be recorded here nicely. Depreciation, it will be 60,000 divided by what? 4. Agreed. But you get something like 15,000. Agreed. So there will be 15 throughout. So depreciation will be 15, 15, 15. Perfect. Then we are done with the P&L. Go to the financial position, the balance sheet. Go to the balance sheet. You record the cost of the assets, accumulated depreciation, and the carrying amount. So for year one, the cost will be, should I record 60 or 100? Now under the deductive, the cost will be what? The 60 throughout. Because that's what you depreciate the asset on, and that should be the cost. So here should be 60,000 to the 60,000 throughout. Then we record the accumulated depreciation to good. So 60 throughout. Accumulated depreciation, here we got 15,000, agreed. Power the depreciation up. Here we got 30,000 going. So continue the game. So here will be 45. Here's what? 30. If there's a scrap value, don't worry, subtract it from this 60. 60,000 minus 15,000, the first year depreciation. Depreciation is 15,000 throughout. How we get it? So first year will be 15,000 cumulated or cumulatively. The second year will be 30,000, right? Good, because 15 plus 15 charge here. The next year will be 45,000, and the next year will also be 60,000, and then the current value will be 0 at the end of the asset life, basically. So that is it. Then I'll go to current assets. And the current asset, I'll record the cash. Government give me or give us a cash of what? 40,000. So the cash should be recorded in here. 40,000. Yes, another first year, just the first year, 40,000. 40,000. Okay, so I'm done with the deductive method. That's all for the deductive method. It is a straightforward one. All what you need to understand is the entire grant will be subtracted from the cost, original cost of the asset, and depreciate the remaining figure. That is all. Most examiners don't like this approach because it's what? Straightforward. Let's go and look at the other one, second method. That one have a little issue. So if you don't understand anything, not that method. So let's go. That's the last method. Then now that method we call it what? We call it the deferred credit method or deferred income. So let's look at that one. I'll do that one here. Deferred credit method. I'll do that one there. Deferred credit method. So deferred credit method. Let's see that one. Okay. Okay, so deferred credit. I'll use the same example, I'll not change anything. And I'll do that one here so that you can compare the difference. Fine. The final answer should be the same. Deferred credit. Deferred credit. Over here, tell the examiner that the entire grant will be amortized over the asset useful life. That's the first point. Point number one. The grants will be amortized over the asset useful life. Have you seen? So the entire grant will be depreciated over the asset useful life. Two. And at the end of every reporting period, a portion of the grant will be released to the income statement or the P&L to offset the higher depreciation charge. So a portion of the grant will be released. Portion of the grant will be released to offset the depreciation charge. And then the C, the asset will be depreciated at the original cost. So the assets will be depreciated at the original cost. Will be depreciated at the original cost. So are we saying that here, grant, depreciate the grant and depreciate the asset? Let everybody be on their own. Yes. Don't let them off. That is so. Now let me back it with illustration. I'm solving the same question as made it word. We are using the deferred grant approach. So the same question using the deferred credit approach. Good. So let's start. P&L, what happened there? So let's go to the P&L. I'll start the P&L first. I'll go to the P&L first. Okay, so the P&L look like this. So the P&L, first of all, depreciation. Depreciation. So year 1, year 2, in fact, up to the last year. Depreciation go on the original cost. So 100,000 divided by what? 4 years, right? That should give us 25,000 cedis. 25,000 cedis. Throughout. And year 3 up to year 4. Then when it comes to other income. Other income. Okay. So other income. The same P&L, other income. Yes, no go area. Great. So this is the deferred credit approach. Most examiners like this method. So I'll tell you why they like this one. So other income, amortize a grant. So what's a grant? So record grant here, open a bracket. The grant itself will be, for the entire grant is 40,000 divided by 4. You get what? 10,000. So every year 10,000 should be the income statement up to the end. So up to the 4-year period. Let's go to the financial position. The balance sheet. In the financial position, first, you should find the current amount of the assets. So I'll do only for year 1 and year 2. We continue with the remaining ones. Now the cost of the asset is 100,000, right? No longer 60,000. Then accumulated depreciation, 25,000, and here's what? 50,000. So this one give us 75,000. This one give us 50,000. Okay, so that's the current amount, average. Now let's quickly hit on current assets. Let's go to current assets. Under the current assets, we will have a cash balance. So this is the asset, total non-current assets. So under current assets, so current assets, I record cash. So the cash should be 40,000, right? For example, give us 40,000. Now let's go and do the hard bits where like it's a bit slippery, but it's not difficult. It's a bit straightforward too. Record non-current liability and underwrite right grant. So write grant. So bracket grant. And write current liability and also write grant. Call it deferred grant. Now, what's the entire grant? The entire grant is 40,000. Let's do some analysis here. Entire grant is 40,000. At the end of the first year, how much have you released the income statement? You have released 10,000 to the income statement. So the grant left with how much? Left with 30,000 agreed. So this 30,000 is a liability to you. It's a liability. But this 30,000 needs to be split into two, current and non-current. Now, you can only get a current one first. The current one is the one they are going to release next year. Now, the entire grant is 40,000. We have released 10,000 to the income statement. So 11 what? 30,000. The 30,000 becomes total liability, which we need to split into two. Current and non-current. That is all. Now, the current one is the one that we are going to release next year. And that's the one that we can get first. So the one I'm going to release next year is here, 10,000, right? It's always the same as the amortized figure. So that means out of the 30,000, 10,000 is current liability. What will the non-current portion? So non-current portion will be 20,000. That is all. Let's go to year 2. So this is year 1. Year 2, the grant is 40,000. We have released what? 20,000, right? So let me do what? 20,000 for us to release. This 20,000 we need to split into two, current and what? Non-current. Current is always equal to the one I'm going to release next year, which is the 10,000. Because it's going to be 10,000 throughout. So the current one is what? 10,000, like this. Then if 20,000 is the total liability and 10,000 current, non-current will be what? 10,000. Good. That is all. Let's go to year 3. Year 3, you have released 30,000. So let me do what? 10,000. And out of the 10,000, the current liability is 10,000. So non-current becomes dash. That's all. So this is how to be. This section, the liability section, is the one that caused a little issue. So that's the end of the game. However, all these answers, they are the same. Both methods will give the same balance sheet, the same balancing figure. Let's confirm that. In the P&L, under the deductive method, we had a depreciation figure of 15,000, right? Let's come here. Under the deferred revenue, we have a depreciation of 25 and a grant of what? 10. Net answer will be 15,000 because grant is an income and then depreciation is an expense. So give a net depreciation of 15,000. Let's come to the balance sheet. If I add 45 to 40, I'll get 80 after the first year. Let's do it here. Here to have 75 plus 40 minus 30 should give us 85. 75 plus 40, 115. 115 plus 30. Now, what happens is this 30 is a minus. How we get? So 100 and should give us 115 minus 30 because 30 is a liability. So now liability have a credit balance. So we net stuff from the asset. So therefore we have what? 85. It is same as 45 plus 40. When you go to the second year, year 2, I have an asset of 50, but a liability of 20 to pay. So give net amount of what? 30. Asset of 50, liability of 10, 10, 20. So liability of 20. So I get 30. So net asset is 30. That's what we see here. And it's continuing like that. Great. So this is the end of IAS 20. So this lecture video, if you look at for IAS 40 and IAS 20. Okay. If you have a question, let me have them. If there are no questions to say that this is how far the good Lord bring us. Thank you very much for coming and have a nice day. Kindly subscribe if you have not done that. And also share the video to your friends. Wow, this one is so sorry. I nearly forget about it. Holiday assignment. Okay, so we are trying question number 8. We are trying question number 8. We are trying question number 8. Work hard. Finish hard. But we are trying question 8 and then success and it's well. That's the only 3 questions there. The work hard, success, and it's for the grand section. Good. So